This is the first part of chapter 10, and we're going to talk about expected returns. In the previous chapter, we talked about what happened before, right? What has happened in the past. Now we're talking about what's going to happen in the future. We're looking forward. We are trying to figure out what is going to happen, and we don't know what's going to happen, right? But we can say something like, okay, next year we have a 30% chance that the economy is going to be great, 40% chance that it's going to be average, 30% chance that it's going to be really bad, right? So we were going to do something like this. We can have as many scenarios as we want. The sum of all probabilities need to be equal to 100%. But we go here and say 30% that we're going to receive 10% return, 40% probability that we receive 5% return, and 30% probability that we receive 0% return, right? We multiply probability times return, we add them all up, and that's going to be our expected return, right? Now, we have something that we call risk premium, right? So it's how much are we willing to, or do we want to receive based on the additional risk that we're taking, right? This is a reward, this is a compensation that investors receive for taking risk, right? So the market risk premium, for example, is the extra that we are receiving for going to the market. If we invest everything in the risk-free rate, we don't have a market risk premium. So if we go to the market, that additional return that we're receiving on top of the risk-free rate is going to be called the market risk premium. Little bit of theory here. The main theory, or the main financial formula that we're using, it's called the capital asset pricing model, CAPM, right? It's a very, very, very famous formula. It has an impact nowadays. I mean, it was this was new in 1964. Sharp is the professor that came up with this idea in 1964. We still use it, right? So again, efficient frontier. This is how much the highest level of return for every level of risk, right? And we're gonna, if we add a risk-free rate, we're gonna have a portfolio that makes a greater return than a portfolio on each on the capital market line. If this were an investments class, we will do all of this from scratch for an Excel. Right now, I'm just chatting with you a little bit. Now, here's the important thing. This is the important thing. We're gonna be calculating something that is called the required return. Sometimes we call this the CAPM formula. It's equal to the risk-free rate plus beta times market risk premium. Beta is the market risk. Beta is unique for every security. Beta is one of the main contributions from the capital asset pricing model, and beta is a multiplier. Beta is the one that is multiplying how much are we receiving, how much do we expect to receive, either magnifies or diminishes the market risk premium. And by market risk premium, it's how much more are we making if we go from the market as opposed to the risk-free rate, right? So this is the return on the market, this is the risk-free rate. The difference is the market risk premium. So beta is going to magnify it or reduce it, right? So if we have a beta greater than 1, we're riskier than the market. If we have a beta less than 1, we're less risky than the market. Now, if the market's doing great and our beta is greater than 1, well, we're getting returns that are unreal, right? It's the dream. What if the market's going down? Well, those also get magnified, right? And you end up having returns that are way, way lower, right? If the beta is less than 1, if times are good, you don't get as much. If times are bad, you don't lose as much. So that's good for you. So we have what is called the security market line, and it characterizes the level of expected return. So this is what I want you to get from this. This is the CAPM line, quote unquote. For every level of beta, which is the x-axis, we should have a level of required return. This is how much are you expect to make based on your level of risk. The riskier you are, you must compensate with a greater return. If you are less risky, you will have to receive a lower return, right? So we have the market portfolio right here with a beta of 1, right? Beta is the sensitivity of our stock to the market. Now, if we talk about the market, well, the market sensitivity to the market is going to be 1 because it's the same thing, right? So if we have a beta of 1, we get the return from the market. If beta goes up, we should get a higher return. If beta goes down, we should get a lower return. Now, this is, no, we must. Not should, we must, because that's the required return. Required return. Think of that as your grades, for example. You might need to make, I don't know, I'm going to make this up. You might need to have 75% in order to pass the class. That is the required grade, right? If you make more than 75%, well, we're all happy, right? If you make less than 75, you are not meeting the